So we're going to talk a little bit about REITs now, because REITs are the other big financial stock that pays out dividends. And like we mentioned before, they're required by law to pay out 90% of their income in dividends. Specifically, we're going to be talking about mortgage REITs, which we will refer to as MREITs probably for the rest of the show, because mortgage REITs is a little bit of a mouthful. Mortgage REIT, they buy mortgage-backed securities. And do you want to talk about this? I'm sorry.
Yeah, so
having a brain fart.
A REIT that's an acronym for Real Estate Investment Trust, REIT. And what real estate investment trusts are, these are trusts, like what you think about as a trust. It's a legal entity that owns real estate related assets. Well, Congress, multiple decades ago, sat back and said, look, if we want to encourage investment into real estate and things like that, let's have these trusts set up in a way that people can put money into them, and that whatever money is earned from those will not be taxed at the corporate level, so long as at least 90% of the taxable income automatically flows through to the shareholders via dividends, right? And so that's where that high payout ratio that we talked about earlier comes in. Well, mortgage REITs are a very specific type of a real estate investment trust, because as opposed to buying into real estate assets themselves, you're actually buying land or buildings. They buy mortgage-backed securities, and more specifically, as a general rule, agency mortgage-backed securities. So these are issued by Fannie Mae or Freddie Mac, and they're backed by the full faith and credit of the United States government. So they're basically the same as buying treasury certificates. And so what mortgage REITs do is they will go out and borrow a whole bunch of money in the short-term credit markets, so your repo markets, your commercial paper markets, stuff like that, where the interest rates are really low, and then they'll invest that money into agency mortgage-backed securities where the interest rates are higher, and then they profit on the spread between their cost of funds and what they're yielding on their assets. And so that's how mortgage REITs make money and are able to have, at least historically, have had such large dividends throughout the years.
All right, I just want to put out a quick disclaimer before we go forward. MREITs have made some people a lot of money in the last 10 years, but the wise investor is going to really want to take a good, long, hard look at any kind of MREIT before buying stock. It's already kind of a chancy area to invest in because you're betting on the spread of interest rates. And sometimes MREITs business practices are not always on the up and up. Specifically, you're definitely going to want to look at any MREIT that's buying mortgage-backed securities that are not agency secured. That's just super, super risky.